Randy Krosner is Deputy Dean for Executive Programs at the Booth School of Business and a former Fed governor. Randy, it's great to have you here today. Do you think the Fed can ease up here?
I think the Fed's got to continue on the path that it's going on, and it is going to continue on that path. I think they understood that inflation is likely to be coming down even before they fully get the interest rate rises out there, but they can't stop. Because if they stop, then inflation expectations continue to move up, and inflation becomes entrenched. It becomes much more difficult to get it out.
It sounds like they might slow down, though. I mean, whether it's the minutes or the commentary we've seen from officials, the idea that they're going to keep hiking by a half a point after the next couple of meetings looks like it's already out the window.
Well, it's the next couple of meetings. I think that's kind of baked into the cake, so that gets them into, at least the next 2, maybe 3 meetings. That gets them into the 2% range, and then I think they're going to sort of assess to see how inflation is evolving, how the economy is evolving, because the economy has also taken some pretty tough shocks from the war, from sanctions, and I think a waning impact of that. All that money that went into people's pockets from the stimulus checks, they're spending it down, and at some point they've got to get the money from somewhere, and that money will be spent out. So they won't. The consumer may not be quite as robust.
I mean, on just a very basic level, though, does the Fed at least need to get to neutral? Is there any reason why they should be below a level that might conservatively be 2%? Neutral could be, I don't know, 3 or 4%, and they suggested they want to go even higher, but for anybody who's suggesting they even slow down this year, that puts them well below those levels.
Sure. And so I think the Fed estimates that neutral's around 2.5. It's somewhere between 2 and 3. Most people would say. Hard to know exactly where it is. And that's why I think once they get around 2, they're going to sort of sit back and assess where things are. But I think they've at least got to get to neutral. I mean, given how high inflation is, and given that we still have such a low unemployment rate, do we really need to have the Fed being extremely stimulative? I think neutral seems perfectly reasonable.
Yeah, I think maybe one of the sources of confusion has been this post-pandemic shift from goods back to services. So we see used car prices falling. We hope that inflation is peaking, but it doesn't mean that we're going to see it completely go away. Strong labor market, services inflation, what's that expected to look like over the next 12 months or so?
Sure. I mean, one of the examples that we've seen just in the last month is airline prices up 18, 20%. People want to go on vacation. It's the first time they've been able to do so in a very long time. So travel's up enormously. And so people want to do a lot more services kinds of consumption. They couldn't get out, so they bought goods and everything was delivered to home. Now they want to get out, and so there'll be a lot of pressure in those areas. So it's not like inflation is just going to come back to 2%. Hopefully, it won't get much higher than it has been over the last few months, and then it'll at least gradually come back down. But it's not like it's just going to be like that.
How high do you think the risk is of a repeat of the 1970s with a stagflationary outcome where we have recessions? It doesn't cure high prices. It goes on for a decade. It takes a long time to kind of finally get in front of it.
So one of the things that I think the Fed has gotten in front of is they're starting to act before inflation expectations become unanchored. Certainly the short-run inflation expectations are very high, but if you look at the longer-run numbers, both from the survey-based measures as well as the market-based measures looking at inflation-protected securities versus non-inflation-protected securities, those longer-run numbers are sort of in the range of where they've been over 5 or 10 years. So that's why if the Fed acts now, it doesn't risk those inflation expectations becoming anchored. If they sort of sit back and say, well, things look like they're getting a little bit better, let's not worry about it too much, then you really worry that this gets baked into wage demands, it gets baked into how firms will be pricing, and then you get into the 1970s. So by acting quicker now, I think we can avoid the 70s. 100% chance that we can avoid the 1970s? No, but a very high chance if they do follow through, at least with the next few meetings of 50 basis point rate hikes.
All right, we will leave it there. Randy, have a great weekend. Thanks for your time today.